Thank you for watching this video. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, March 11th, 2022. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the developer and president of Simple Market Signals at simplemarketsignals.com. We will be working off of a weekly candlestick chart of the S&P 500, and this chart starts in 2021 and, of course, runs through Friday, March 11th. So let's start off with the weekly performance. For the week, in the upper right-hand corner where my cursor is circling, we can see that the S&P 500 was down 2.88% this week, and we closed at 4204.31. Now, we're going to start off with a clean slate here, and we're going to do the annotations together. So the first thing I'm going to do here is bring up this annotations tool, and we're going to draw a horizontal line at the 4350 level. And the reason for that here, guys, is we know that this 4350 level has been an extremely important support and resistance level since going back to June of last year. All right, so we need to start off there because this is going to be super important going forward. So we got up to the 4350 level here in June of 2021. We had about 4 weeks where we traded right around this level, but as you can see here, after the 1 week right here in July where we closed below 4350, we did not have, until this downturn, we did not have one weekly close below 4350 since this second week in July, all right? But we've had 1, 2, 3 weekly closes now below 4350 during this downturn, which really started on January 4th of this year, where we hit the all-time intraday high, 48.1862. Of course, I don't have that annotated, but it's important to understand that. Now that we've had 2 weeks in a row where we've closed below 4350, and we know that the 4350 level was a super important support level, the question we have to ask ourselves is, where is the next support level? Well, it's really about where we're at, right? We closed at 4204.31. We know that the 4200 level, and I'm actually going to draw a box around this because this level right in here, right, we had some trading around this area. Not a lot, not near as much as what we have experienced at the 4350 level, but we had some trading right around here, and it's going to be 4200 plus or minus about 50 or 75 points. All right, so this area, guys, right here, and again, we stopped right in the dead center of it, as you can see. So this is where we're at. There's maybe 10 weeks or so, about 2.5 months of trading, right? April, May, first part of June of 2021, where we traded right here. But below this, guys, it starts to get pretty ugly, all right? And so let's take this chart back. I'm going to back this up. Actually, let's take this back 2 years. So we're going to take this back to the 2019, January of 2019, and what I'm going to show you here is a Fibonacci retracement because these Fibonacci retracements are just amazing how well they work. And if we're going to retrace 38.2%, which is a major Fibonacci retracement, right? And the way this works is you start at the lows of your prior downturn, and that was, of course, the COVID lows, March of 2020. So we start there, and we go to the peak of the market, right? The recent peak. And then the way this works is there's 3 major numbers, 38.2, 50%, and 61.8. But if we were to pull back 38.2% of the entire move from the March of 2020 lows to the peak in the market here at the end of 2021, beginning of 2022 here, that would take us down to the 3,800 level, all right? And so 3811.43 is exactly where this lies right now. Let's just call it 3,800, close enough. So what we can see here is this 4,200 level right, which is where we're at right now, guys, I don't know. I mean, could it hold? Yeah, but it doesn't seem reasonable based on what we're experiencing, the invasion of Ukraine, and it just seems like things are getting worse. All right. Now, I don't try to make predictions, right? Anybody that makes predictions, I think they're pretty full of themselves, guys. I mean, come on. Nobody can predict the future. What we can do from technical analysis is use a much more responsible approach, which is what I try to do, and look at if this, then that, okay? Which is what how I learned to think by studying other very successful investors and traders throughout history. If this, then that. So the way this works is if this 4,200 level, which is right where we're at now, does not hold, then, right, if this, then that, then the next level of support is really going to be around this 38.2% retracement level. You can see that these two kind of line up. And that's going to be 3,800 plus or minus, 50 to 100 points, right? So let's call it 3,700 to 3,900, but 3,800 is the midpoint, and that puts us right there at that 38.2% retracement, which, by the way, is going to also take us into a bear market, okay? Anything below a 20% drop, right, from the peak in the market to where, you drop 20% plus, and that would actually be right around in this area as well. So if the 4,200 level doesn't hold, then it would be reasonable to expect the S&P 500 to fall to 3,800 plus or minus. That would put us in a bear market. And if that doesn't hold, then you can see that the next level of support, and look at how amazing, this stuff lines up, right? The 50% retracement level, which is not a true Fibonacci retracement, but it does work extremely well and frequently in technical work. So if we were to lose 50% of the entire move that we saw from here to here, that would put us down to the 3,500 level, and you can see there's a lot of support. You can see the top of these weekly candles back in August, September, and October, right into the beginning of November of 2020, and that lines up perfectly with the 50% retracement level. 3502.20 is where that lies. Let's call it 3,500, close enough. And then you can see there's a pretty thick area of trading between the 50% and the 61.8% retracement, which is around 3,200. So, if, right, the 3,500 level doesn't hold, then we would probably find ourselves somewhere down in here, going down to the 3,200 level. And if that doesn't hold, then, it would, conceivably, we could retrace the entire, right, round trip, the entire move, and find ourselves once again down into the 2,200 level on the S&P 500. It's way too early to think that might happen. The more responsible way to approach this is just to look at each one of these logical areas where we might run into some support and approach it with the if this, then that scenario. So if 4,200 doesn't hold, and as you can see, there's not near as much trading here as what there was at 4,350. But if this doesn't hold, again, probably find ourselves somewhere around in here. That would put us in a bear market as well. And if that doesn't hold, then we're probably going to see 3,500. If that doesn't hold, we're probably going to see 3,200. And if that doesn't hold, holy moly, it could get clear down to the 2,200 level. So let's keep our fingers crossed and hope that it doesn't get that bad. But we were just there two years ago, so to think that it couldn't happen would be to be naive. But let's not get ahead of ourselves. As long as the 4,200 level holds, plus or minus, all right, the worst is behind us. But I think that at this point is probably a little optimistic. I think, at least a very realistic scenario based on what we know is to probably expect, again, I'm not trying to make predictions, but it just, being real, right? Being, looking at the way it feels, we would be naive to think that this 3,800 level over the next month or two, that it couldn't happen. And I think that the probabilities are probably fairly high. All right. But right now we find ourselves at 4,200. So if guys, if you still have some long exposure in your 401k, IRA, or whatever, and if you don't have a good system, right, a system, a reliable, repeatable system to take the emotions out beyond technical work, right? What I'm talking about here is I have a proprietary model that took me over 20 years to develop. I use it for my personal investing and trading. I'm sharing the information with you, and at this point, I'm going to tee up some more information about that. So, if you have hundreds of thousands or millions, as a lot of you guys do in your 401ks, your IRAs, or whatever, and you want a reliable, repeatable system to help you manage your own money, whatever, even if you have a financial advisor, if you manage any of your own money, whether it's a few thousand or a few million, please pay close attention to the balance of this video because it could be worth a lot of money to you going forward. Now let's go back and take a look at how simple market signals could have helped you in the bear market that started in 2000, that ended in 03, and then next we'll take a look at the bear market that started in 2007 that ended in 09. So in 2000, you can see that the risk signal, the market mode signal, would have turned red right here at approximately 1450 on the S&P 500. And this risk signal, the market mode signal, would have been red through the majority of this downturn, and then turned green right here just under 900 on the S&P 500. So think about that. Any of you that lived through this, any of you that were invested in the stock market during this period of time, as I was, right? I was working for Oppenheimer Funds, the mutual fund company, during this time. But you can see here, guys, this huge drawdown, right? This hurts, and it lasted for several years, and it just felt like every time we were starting to pull out of this, something would happen that would send us lower, all right? And these types of downturns, these prolonged downturns that last years, they are brutal. But think about how much knowledge you'll have when the risk signal is red whenever we get to the next bear market, right? Whether it lasts a few months or a few years, when you know that that risk signal is red, you know what to expect, right? Losses are much more likely than gains, and so you can take the proper measures to protect yourself, and you'll have realistic expectations as to what is probably going to happen. But then when that risk signal turns green, you know that the likelihood of you making money has substantially increased, okay? Now let's take a look at the bear market from 07 that ended in 09, and you can see here that the risk signal would have turned red right here, right around 1500 on the S&P 500, and you can see that the risk signal would have been red for the majority of the downturn. We did have one short green signal right here that lasted 1 week, and then the market rolled back over, and so maybe you would have had a small loss here, okay? But that's just the way any type of protective system works, guys. But think about this. Again, you could have got out, or went to cash or done whatever you wanted to do right around 1500 to protect your portfolio, and you would have had a green signal that would have came out around 875 on the S&P 500 right here in 2009. So 2 of these types of downturns in the course of a decade, and simple market signals could have helped you really protect yourself and really understand what was going on in the market and set realistic expectations for you in both cases. And when the risk signal turns green, as it did right here, you will know that the likelihood of you making money in equities has substantially increased. Why is simple market signals so important? Because market risk is the single biggest risk most investors face. And market risk is non-diversifiable risk. Market risk cannot be diversified away. And future investing success will require getting in sync and staying in sync with the stock market by using stock market-driven data. Simple market signals is built around a multi-factor stock market-based model. I'm going to repeat that. Simple market signals is built around, based on, a multi-factor stock market-based model. Simple market signals identifies the current level of market risk, giving you the opportunity to stay in sync with the stock market. Now let me share with you what subscribers are saying about simple market signals. First, we are going to hear from KT from Michigan. I have been trading for many years. I did not realize that I have been trading in a completely blind fashion. SMS has given me the direction, literally, I've been desperately needing. This service allows you to clearly see what the market is doing. If you are remotely serious about trading or investing, you must try this service. Again, that's from KT from Michigan. KT, thank you. I appreciate that feedback. Next, we're going to hear from SC from Florida. And SC writes, I manage my own money and I am not a professional, which could lead to a disastrous outcome as it has for many. Simple Market Signals is the equivalent of having a personal money manager that keeps you invested when it counts and alerts you to the potential dangers ahead. Now, I want to point out here, guys, I used to be a money manager. I sold my practice in 2016. So these are the exact words that SC from Florida wrote to me. So I just printed it as is. But I want you to understand, I cannot give advice. But this is the feedback that SC from Florida gave me, so I appreciate this. So again, SC writes that Simple Market Signals helps you stay invested when it counts and alerts you to the potential dangers ahead. The service is extremely affordable and takes the uncertainty and fear out of being in control of your own investments. I have done very well using this system and consider myself lucky that Rodney's YouTube channel came into view one day. I highly recommend this to anyone who desires an easy system to produce positive returns in the markets. Again, that's from SC from Florida, sent from his iPad. And guys, I want to point out the reason I'm using just the first and last initials is for the security of my subscribers, okay? I have hedge fund managers, very well off, multi-millionaire clients. I have, people that are high up in various areas of the government. I have people from all walks of life. So just out of respect and security for my clients, this is the way that I'm presenting the information, just with their first and last initials as well as their state. Next, we're going to hear from FS from Massachusetts. Rodney is spot on in his reading of the markets. I was looking for a heads up to help me choose which side to use for vertical spreads. Again, that's from FS from Mass, and thank you so much, FS. I appreciate that. Next, we're going to hear from JV from New York. Now, I posed a few questions to my subscribers a few weeks ago, and this is the feedback exactly that JV from New York gave me with respect to the question. So I produced it just as he wrote it. So the first question, what do you like best about Simple Market Signals? What JV said was, one of the things I like best about Simple Market Signals is that I have an easy-to-use tool at my disposal. I use the green, yellow, and red signals along with the general trend to help me determine how much equity risk exposure I want my investments to have in the market at any one time. I will either increase or decrease my equity exposure based on those metrics. The next question, what is important about Simple Market Signals to you? JV writes, I am a conservative investor. My main goal is to preserve as much capital as possible during market downturns, yellow and red signals, and to optimize my returns during green light conditions. The next question, how has Simple Market Signals helped you? JV writes, SMS helps me to determine whether to stay the course, increase equity exposure, or take defensive positions. For example, I will add additional funds to my equity investments during green conditions and move money to cash during red conditions. And the last question, how have you benefited from Simple Market Signals? JV writes, one of the benefits of SMS is that it has reduced the stress from always looking at and analyzing market conditions and worrying about it on a daily basis. And again, this is from JV from New York. JV, thank you so much for the feedback. I really appreciate that. There's two major components to the Simple Market Signals proprietary model. There's the risk mode, the market risk level signal, and then there's the general trend indicator. Let's start off with the Simple Market Signals risk signals. The Simple Market Signals risk signals, the market mode signals, are simply green, yellow, or red. When the signal is green, this is when you're going to have your easiest, lowest risk profits, and this is when the market is generally in an upward market mode. When the signal is yellow, this is when we have a soft market, and the market is generally sideways to slightly up or down in a yellow signal environment. And what you're going to find is when the market mode or risk signal, right, you can refer to it either way, but when the market mode signal is red, the worst losses, including bear markets, are going to happen in a red signal environment. So when the signal is red, the market is generally in a downward mode. Next, let's take a look at the general trend indicator. The general trend indicator measures the trend of the stock market based on our proprietary formula. The signal is either positive or negative. When it's positive, we're in a upward general stock market trend. When the signal is negative, we're in a downward general stock market trend. Now let's take a quick look at a few market mode risk signal charts for the last few years. We're going to start off with 2018, and you can see here what I was talking about, that most of your upward progress in the stock market will be made in a green risk signal environment. The yellow signal is kind of a sideways to slightly up or down signal, as you see here. And then the red signal, right, this is just 2018. We'll look at a few more here in a second, but you can see the red signal here that we had in the latter part of 2018. And then moving on into 2019, we came into the year with a red signal, and then it went green, and you can see the progress that we make here. Yellow, correction, green, yellow, green, yellow, green. So you can see that most of the yellow signals go back into a green. The yellow is kind of a short pullback in a lot of cases, but as we saw here in 2018, and what you'll see also in 2020, is the yellow signal can be that transition signal between a green signal and then a red signal, as we see here with the COVID sell-off in February, March of 2020. And again, as we see here, right, most of the upward progress in the stock market is going to be made in a green signal environment. So think about this, guys. As long as the signal is green, you can see there's just not a lot to worry about, right? And even most of these yellow signals, this is when we get that pullback, but it gives you confidence in knowing what the market is doing. Now let's take a look at a few charts for the general trend indicator. And just like with the risk signal, we're going to start off with 2018. You can see we came into the year with a positive signal, had kind of a chop here where we went back and forth between positive and negative for a little while in February and March. We had an outright negative signal and then went back into a positive. But you can see here, right, this sell-off that we had in Q4 of 2018, we've already looked at the fact that that risk signal went red, and you can see here that we would have had a negative general trend indicator signal as well. And then you can see here when the signal is positive, this is when you get the most upward progress in the stock market. And this takes us into 2020. Of course, we had the negative signal right here during the COVID sell-off in February, March of 2020. And this takes us again to the end of August, beginning of September of 2021. And you can see here positive, very short negative signal, and then a nice long positive signal. And again, just like with the risk signal, I'm stopping the data at the end of August. And if you want the most current information, please become a subscriber. The signals are delivered to subscribers in our weekly video newsletter. In the weekly video newsletter, you will get weekly updates on our proprietary market mode signal. That's our risk level signal. And of course, you'll also get the updated chart for that signal each week. You will also receive the proprietary market mode risk level signal on all 11 major sectors of the S&P 500. You will also receive a weekly update on our proprietary general trend indicator signal, and of course, the updated chart for that. You will also receive market analysis on over a dozen charts every week covering all major areas of the stock market, including several international charts. So I'm going to cover small, mid, large. We're going to cover both a growth and a value ETF. I mean, guys, this is going to help you understand what's going on across the board. Of course, several charts every week on the S&P 500. We'll cover the Dow. We'll cover the triple Qs. So we're going to cover pretty much everything in there, okay? And so this is going to give you a really solid base every week as to what's going on in the stock market over and above our proprietary information that we're sharing with you. And then depending on what's going on, there will be occasional bonus material, not necessarily every week, but occasional bonus material, and this will be anything additional. From week to week, these things will vary, but these will be important and timely things that I feel that you guys need to know at the time that the information is delivered. Okay, so that'll be the occasional bonus material. To be fair to myself, I should be charging $97 per month or more for this information. However, you're going to get everything for just $19.99 per month. That's less than 67 cents per day. And to become a member of the channel and get access to the Simple Market Signals information, you will need to go to the Rodney E. Constable Stock Market channel. So depending on how you found the video, you may or may not be there, but you need to make sure that you go to the Rodney E. Constable Stock Market channel, and then you're going to click on this join button. Now, if you're not signed into YouTube, you will need to sign into YouTube. All right, and then once you're signed in, then you'll see this box pop up, right? Get access to exclusive perks when you become a member. So you click on the join button and you will see the information here, what you're going to get with your subscription, of course, your membership. And then you click on the join button and you want to add your credit card information. So as you can see here, you can pay with either a credit or debit card, enter your card number, of course, the month and year of expiration, security code, cardholder name, and your billing zip code. So I'm going to fill all of this information in, and I will be right back. So once you hit that buy button, which is in the lower right-hand corner of that box, that previous box, you will then get this pop-up. Welcome. It's great to have you as a member. So then you can click on the See Perks. So once you fill all that out and your membership is established, then you will have access to the membership area where you will be able to see the perks, right? And then you go over to the community tab, and this is where you will have access to the various videos, and you just click on those and it'll pull those up. Okay, so I'm going to back up here, and so this is where all the training videos will be, as well as the weekly updates to the Simple Market signals that will be under the community tab. And that's all it takes to become a member. It's quite simple. And you will have easy, convenient access to this information. Everything is on YouTube in the members area of the channel, and everything is in video format. There's no emails to mess with and no websites to log into other than, of course, YouTube. So just to review the membership details, the video membership to Simple Market Signals through YouTube is $19.99 per month. That's less than 67 cents per day, and it's billed monthly on your credit card, or you can pay with PayPal. There are no contracts. You can cancel anytime, and if you do cancel, your membership will remain active for the balance of that current month, right, for that prepaid period, but you won't be billed for the next month. All memberships are controlled by YouTube, so if you ever have any question about anything, just Google it, and the answers should be out there. Some of my clients tell me they make tens of thousands of dollars per year from the information they learned from being a client of Simple Market Signals. It's not often you have the opportunity to invest a few $100s per year in yourself and potentially pull out thousands or tens of thousands of dollars per year from that tiny investment. This year, give yourself the gift of financial knowledge that can bring you big rewards over your lifetime. Now let's recap what you will get as a member. As a member, you will receive the weekly video newsletter, which includes the weekly update on the proprietary market mode, also known as risk signal, on the overall U.S. stock market. You will also receive the weekly update on the proprietary market mode or risk signals on all 11 major sectors of the S&P 500. You will also receive the weekly update on the proprietary positive-negative signal for the general trend indicator. You will also receive weekly market analysis on the overall market, and there's generally 12 plus and sometimes more than 20, right, depending on what the information I need to disseminate. But there's generally at least 12 plus charts every weekend covering all major areas, right? Small, medium, large, growth value, all of that, including several international charts. But all of this is over and above the proprietary risk signals. So the weekly market analysis alone, guys, is worth far more than the $19.99 a month that we're talking about here, okay? Plus, you will receive occasional bonus charts as deemed necessary and appropriate for whatever's going on in the markets, all right? So that's bonus material that I do throw in from time to time, and that can be extremely valuable to you. Plus, you will receive special midweek updates when warranted. So again, if there's something going on in the markets, if there's a signal change in the middle of the week, we will put out a midweek update video so that you can stay current on the information. We'll get that out as fast as necessary, okay? And you'll also receive access to the growing video library of best practice educational videos that are part of your membership, and that will continue to grow over time, all right? Again, you're going to get all of this for just $19.99 per month. That's less than 67 cents per day. So join now to start benefiting immediately from this valuable and potentially life-changing information.